C is for capital gains. How are you guys doing today? My name is Apple, and today we are filling in the financial gap between schools and the real world. And today we're coming out with this third installment of our financial literacy A to Z series, which is tying together the video here with a corresponding blog post on my website, applecrider.com, that we just got live. So be sure to check out that blog post. It's going to provide a lot more value going in depth on this topic. So again, in the video, we're going to cover a more broad overview of the topic. We're going to talk about what it is, why it's important, and then if you hop over to the blog post, we're going to go a lot more in depth on the actual topic covered. So today, capital gains, and just ways that you can apply some of the topics we talk about in the video to your real life. So if you're all interested in that, be sure to hop over to applecrider.com, check that out. And without further ado, let's just hop right in to the video. So capital gains, what is it? Capital gains, essentially, all it means is the increase in value of an asset. So it's just the increase in value of any assets that you own. Assets, like we talked about before, are anything like a stock, a bond, some real estate, a business, even just cash. So all these things are examples of assets. So say you bought some Tesla stock a while ago for like $100. At this point, Tesla stock's worth like say $350. So you made a profit of $250, and your capital gains on that investment in Tesla would be $250. So it's a very simple topic to understand. It's just the increase in value of the things that you own. Say you buy a home, some real estate for $200,000. It appreciates over 10 years. Now it's worth $300,000. Your capital gains on that is $100,000. So the flip side is your capital losses. So say you bought that same $200,000 house 10 years later, it is only worth $100,000. That is a $100,000 capital loss. Same thing if you bought stock for $200, now it's at $100, you just capital lost $100. Simple as that. All right. But an important thing to know about capital losses is that they can actually be used as tax write-offs. So if you do lose a significant amount of money from your investing in a year, you can write that off against your taxes and pay less in taxes, which is something that not a lot of people actually do if they're investing and they did lose some money. They should definitely be aware that they can actually use that as a tax write-off. So just a little bonus right there. Get your tax write-offs with your capital losses. Hope you don't have any capital losses, but if you do, be sure to utilize them to their fullest and get those tax write-offs. They're also used to offset capital gains. So like say you got capital gains of like, I don't know, $300 this year, but you had capital losses of $300 as well, then you can use that to offset your capital gains and not pay any taxes. Again, I'm not a tax specialist. I'm not like a certified financial planner or anything. So definitely go out and talk to an attorney for your specific tax questions. But this is just like some tips for how to reduce the amount you're paying in taxes. If you have capital losses, be sure to take advantage of those. All right, so when capital gains are important is when you actually sell an investment. Same goes with capital losses. So they're not important until you actually sell. You're not taxed on anything until you actually sell. So when you sell an investment, when you sell an asset, it is called realizing your gains or realizing your losses. So at that point is when you are taxed, and you have to report that on your taxes. But until then, you do not have to report it and you don't have to pay taxes on it. So Warren Buffett, he's like the investor, at least in the US. He's like the top, most famous, one of the richest dudes on the planet. What he does a lot of times is he just buys stuff, holds on to it forever. You never have to pay taxes on it if you hold on to it forever. And then you can just potentially pass that down from generation to generation if they're paying you dividends. Lots of cool ways to preserve your wealth. But let's talk about realizing your gains. So when you actually sell and you realize your gains, that is when you are taxed. But besides just holding on to your investments forever until you die and giving them to your kids, there's a different way to avoid paying capital gains taxes that we're going to talk about at the end of the video, so be sure to stick around for that. But yeah, now let's talk about why they're important. So now that you know what they are, capital gains, just when the value of what you invested in goes up, pretty straightforward, and realizing gains is when you actually sell. So why is that important? Why are capital gains an important thing that you should know about as an investor? Well, depending on how long you actually hold an investment, you are taxed at a different rate. So with capital gains, there are two types of taxes on your capital gains. You've got your short term, you've got your long term. And the distinction between short and long term is obviously how long you hold them for. So if you hold a stock, if you hold a bond, if you hold real estate, whatever, for less than a year, so if you hold it for say 9 months, and it appreciates, and you sell it after 9 months, you're going to be taxed at a short-term capital gains rate. However, if you held that for say a year and a half, maybe 18 months, maybe 24 months, maybe like 10 years, then you're taxed at a long-term capital gains rate. And the distinction here is that your long-term capital gains rate is going to be significantly lower than your short-term capital gains rate in terms of taxes. So with your short-term, you're going to be taxed at your normal income tax level. So depending on which tax bracket you're in, how much money you make, that is going to determine how much your short-term capital gains rate is. So if you're in like the 25% tax bracket, you're going to be paying 25% on all your capital gains, which is going to significantly eat into any of your profits. So again, if you bought that $200,000 house, sold it for $300,000, you had $100,000 of capital gains, 25% of that is going to the government if you only held that for less than a year. Whereas if you invest for the long term and you take advantage of that long-term capital gains rate, if you're in that same 25% tax bracket, if you hold it long term, you're actually down to a 10% tax bracket, and you're only going to be paying $10,000 on that $100,000 capital gains instead of your previous 25% that you had to pay previously because you only held that for 9 months. So there's some very serious advantages to holding your investments for longer than a year. And a lot of people, what they'll do is they'll hold their investments for like a year and a day or like just over a year so that they can actually take advantage of those long-term capital gains taxes instead of being taxed at a short-term capital gains rate. And I mean, as you can see from that example that we gave with the house, we're talking lots of money here. So, I mean, just that house example, you had $100,000 worth of capital gains. You either pay $25,000 or you pay $10,000. So we're talking tens of thousands of dollars here, guys. So you got to know your capital gains and you got to know your long-term versus short-term because there are literally tens of thousands of dollars on the line with some of these investments or assets that you may be holding. Now, there are some investments where you're not going to get a choice and you're going to be taxed at that short-term rate no matter what. Now, some of these include your dividends and your mutual funds. So let's talk about both of these. So dividends. Why are dividends always taxed at a short-term rate? Well, that's just the way it is. Dividends are taxed at a short-term rate because they're paid out to you usually every quarter, that's less than a year, and the government just decided that dividends are going to be taxed at your short-term rate. However, with mutual funds, it's a little more nuanced than that because even if you hold a mutual fund for longer than a year, your investments within are going to be taxed at a short-term rate. So I made a whole video about mutual funds. If you don't know what those are, be sure to check that video out. But the reason that mutual funds are taxed at your short-term rate is because the active mutual fund manager is actively buying and selling investments on sometimes even like a daily or weekly basis. So you are not in control of what investments are held within that mutual fund. The manager is, and they can be buying and selling whenever, and they're going to be passing these taxes on to you in the form of expense ratios and just reduced earnings on your mutual fund in general. So those taxes are passed along to you as the owner of the mutual fund, and you have no control that the mutual fund manager is buying and selling these stocks less than a yearly basis. So your best bet with investments is really to just hold them for the long term. And I mean, there's so many advantages to holding your investments for the long term. Like we talked about in my bear and bull market video, if you can hold it through a bear market, you're going to, since markets tend to trend upwards, you're going to make money if you're in it for the long term and you're not selling based out of fear when the market crashes. If you're able to just hold on and weather the storm, then you're going to be able to realize a lot more capital gains than if you are going short and having to pay those short-term capital gains rates. So throughout history, there's actually never been a 40-year period where the stock market did not go up in value. There has never been. You could put in any period of time. You could include the Great Depression. You could include the Great Recession. You could include any 40-year stretch of time. There has never once been a time where the stock market did not trend up throughout those 40 years. So that just speaks lows to me on the basis of going long is just the way to do it, and not going long is just doesn't make sense to me at all, because if you go long, you're playing the winning game, and if you go short, you are, in my opinion, you're not playing the game that you're going to win every single time. Whereas if you're going long, I mean, the data says that if you have gone long in the past, you have won. So I'm going to take that and learn from that and think that if I go long in the future, it's going to pay off for me as well. Now, like I promised before, there is actually a way to avoid paying capital gains tax in general. And the way to do that is to invest through a Roth IRA. So I've made a couple videos about Roth IRAs in the past, and I'm a very strong advocate for Roth IRAs. I have a Roth IRA. And what a Roth IRA is, the IRA stands for Individual Retirement Account. So it's a way for you to invest for your retirement, and it's a way for you to do so without having to pay taxes on your gains. So this is really, really cool. And the way it works is the money that you put into your Roth IRA, you've already paid taxes on. So assuming you got it from like your employer, you paid income tax on that, then you put that in your Roth IRA, and you're able to invest that, and the gains that you get on that is completely tax-free because you already paid taxes on that when you received it from your employer. They already took out the income tax, so you already have this money that's been taxed. Now they're not going to tax you again, so you invest that in your Roth IRA, you get all these capital gains, and then once you retire, you don't pay any taxes on that, and that is just an amazing, amazing way to go. Again, I'm not an attorney or anything, so definitely talk to a tax specialist to get your specific details, but that is just a cool way to take advantage of not having to pay those capital gains taxes. Anyways, that about wraps it up for the video, guys. Be sure to head over to applecrider.com, check out the corresponding blog post to this video on capital gains. I think it'll be very beneficial for you, and I'm providing some more value and showing you a more in-depth look at capital gains, whereas compared to just the video here, that was a more broad overview. Anyways, thank you for sticking around. I do appreciate it. Please leave a like and subscribe if you enjoyed. I'll see you tomorrow, and until next time.